And so I'm just borrowing money against the couple real estate assets that I had to finance my lifestyle until all my commissions come in. Who wouldn't, right? Of course, in 2008, it literally falls off a cliff. I went from selling a couple hundred lots and a couple hundred condos to zero. At the time, my wife is my girlfriend. And I'm trying to convince her I'm a good prospect, and I find myself in 200 grand of debt, and I've got like negative 5 grand of cash flow every month. She says, hey, if I was negative 200,000 of net worth and negative 5 grand a month of cash flow, would you marry me? God bless her. She stuck with me. And then I just started doing whatever real estate deal I could get my hands on. And those commission checks would go to pay off those debts while she was helping to keep us afloat with her job. Going through that forever changed my DNA as an investor.
What's up, Ivan? Good to have you on the show.
Justin, it's good to be here, man.
Well, this is exciting. You and I got a chance to meet actually in Florida. We were spending time at an event. It was a Wellspring event, and we were hanging out with Tim Tebow at this event, playing some pickleball. The guy, by the way, is incredibly good at pickleball. And your buddy, Scott Lingle, who's another entrepreneur, he introduced us and we connected, and you're big in real estate. I'm big in real estate. I think you're in Tiger 21. I'm in Tiger 21. And there were a bunch of synergies, and it was like, hey, let's talk about what we're talking about right now, but so everyone else can hear it. And so here we are.
Here we are, man. It's good to see you. It's good to be here. It's, it's been a few months since that event. Time just keeps flying. But
it does.
Exciting. We're recording this instead of just doing it one-on-one.
That's right. Well, that's how I feel. It's like, I love getting time with people. I love learning. I'm an eternal student, but a lot of what I like to learn, I think other people are probably interested in as well. So if I can learn and let other people listen in, that seems like a lot of fun, because I like doing that for other people, when they're learning, man. And I want to listen in on what they're learning about.
For sure. Book club and more.
That's right. So tell me, how did you kind of get your start in real estate? You've done very well. You have a company that you've grown for 20 years. You've been in the real estate industry for 20 plus years. But how did you get started in real estate? I mean, was that nerve-wracking at first? Did you just jump right in? I'd be curious to know kind of like the humble beginnings and then how you scaled to where you are today.
Definitely more of a fire, ready, aim kind of guy. Absolutely. Jumping right in. So my first taste of real estate was mowing lawns for my father's rental properties. He would wake up my brother and I at the butt crack of you-know-what. And he would have us mow lawns, and literally 7 years old, having to push a mower at his rental properties, and absolutely hated it. But looking back on it in my teenage years, I thought, well, gosh, if I owned a bunch of these, I wouldn't have to have a real job. And I think it was around, it was 1996. Rich Dad comes out. I'm graduating high school, and my dad actually gives me this Rich Dad book. He was an eternal student, or is an eternal student, big time reader. He had all kinds of audio tapes in the car, all the old greats like Earl Nightingale. We used to listen to this stuff ad nauseum, and of course his kids were like, "Dad, can we please just listen to some music?" But those things sort of took root. So read Rich Dad Poor Dad, immediately got hooked on the idea of having a big what Robert would call a B class or B quadrant company, and knew that real estate would be my vehicle. Early on, I thought, I wanted to be a developer, and how sexy would that be? And I'd maybe one day develop world-class resorts. However, getting out of college at IU, this is now fast forward to 2000, I'd been studying real estate.
IU being Indiana. I just want to point that out, right?
Yeah. Indiana University, studying real estate at one of the top undergrad schools in the country for real estate finance. Thought I was pretty hot stuff. Thought I knew a lot about real estate. And I got out. It's .com. We're in a small recession. .com bust. And I really didn't know what to do, so I started doing some odd jobs for some real estate guys, and through that, got my foot in the door with my first mentor. Again, back to Robert Kiyosaki. I told the guy, I'll work for free. I just want to learn and work to learn instead of work to earn. And by that, I had a pretty strong knack for sales. I had some sales jobs in college and high school, and so he put me in charge of selling condos and selling developed land to builders. And that went really, really well through 2003, 4, 5, 6. Again, my ego's even bigger now, right? I'm selling condos, fastest selling deal in town. I'm selling land to all these builders in the number one suburb in Indianapolis. And I'm adding up.
And it's easy, right? Everything's easy right now. Like easier than easy.
So easy. So easy. I mean, almost just, you put the purchase agreement on the door and you come back and it's been signed. And I've got another developer now that I'm selling even more condos for. And 2007 looks a little shaky. And I've got all these units in my pipeline. And so I'm just borrowing money against the couple real estate assets that I had to finance my lifestyle until all my commissions come in. Who wouldn't, right?
Oh, who wouldn't? A lot of people did that.
So 7 looked pretty shaky, but kept the train going. And then, of course, in 2008, it literally falls off a cliff. I went from selling a couple hundred lots and a couple hundred condos to zero.
Wow.
And at the time, my wife is my girlfriend, and I'm trying to convince her I'm a good prospect. And I find myself in $200,000 of debt, which seemed incredibly high at that stage in my late 20s. And I've got like negative $5,000 of cash flow every month. And she asked me, she says, "Hey, if I was negative 200,000 of net worth and negative $5,000 a month of cash flow, would you marry me?" And that was, that was a lot of humble pie. Definitely hurt the confidence. Very humbling is an easy word, but felt pretty crappy, and really didn't know, at least at that time, how I was maybe going to get out of that. Somehow I convinced her to stay with me. And we moved out of my big fancy condo that I'd bought during the heady days, and we squeezed back into my duplex. We moved from 2,000 square feet to 750 square feet. The first 3 months we were there, her sister lived with us.
Oh my goodness sakes.
And we rented out the condo because we couldn't sell it. We were underwater. And I'll never forget, every month that nothing went wrong on the condo that we were renting, we only owed an additional $600. And those were just tough times. I had to get money in the door, right? And so at night, I would drive 45 minutes to a town where I prayed no one would recognize me, and I would deliver Papa John's just to get money in the door and to stay in real estate, because I was convinced that I could somehow dig out of this. But my fiance at the time saying, "Hey, we got to get cash in the door." And I can remember.
By the way, for perspective, to those of you that are tuning in here, you're not only $200,000 in debt, but you're going $60,000 in debt per year, right? You said you're 5,000 negative cash flow every single month. So if you don't do something drastically different, you're going to be in a world of hurt. It's not just where you're in debt. It's that your lifestyle, your expenses, everything is, it's like
dad, her dad comes to me, man, and he's like, "Hey, have you considered bankruptcy?" And the only thing I still had was my credit score. My credit score was still pretty good because I've been managing to make all these payments up to this point. And I really didn't want to do that. I had to protect that credit score, which would help me later. And God bless her, she stuck with me. She would help make the monthly payments, and then I just started doing whatever real estate deal I could get my hands on Before this, I was too big to do a residential deal. I was too educated to help somebody buy or sell a house, right? Or to manage property. I would do any deal I could get my hands on. And those commission checks would go to pay off those debts while she was helping to keep us afloat with her job. And so my job was to just work us out of debt, start with the highest interest rate and debt and work our way down. And that's really where the soul searching really started beginning. And it's a long story, but finally figured out I'd have to do what I really didn't want to do to get to do what I want to do later. And I started a property management company, dealing with other people's tenants and toilets, to get cash flow coming in the door and to start building a business.
Yeah. Well, I'm in that business. It's not glamorous. It's one of the worst businesses out there, even from, a margin standpoint, depending on, what actual skill set or technical, job that you're in or what your company specializes in. It can be incredibly lucrative, but it is hard to make money in a services business, in a property management services business, when you're not also buying the land, buying the properties. And so I can empathize, I can relate. Luckily, we picked some niches that have done well. But it's funny, you shared the story of the condo that you were in and then moving out of it. I was in a condo at the same time, and I moved out of it. Yeah. And mine was for different reasons. I had an opportunity to take over more territory for a company that I was involved in, and open up a retail store. And so I ended up moving and renting this out. I wanted to sell it. I was already underwater, couldn't sell it, rented it for years. It was negative cash flow because I never bought it to be a rental, so I tried to convert it into a rental, but I had an HOA and I had all this stuff. And this is when I lived in Chicago, so more expensive. It was actually in Lincoln Park, and it was a pain. I lost money every single month for years and years and years. And I finally, just to get it commandeered so much of my mental space, I just didn't like that I was always thinking about it, and I was always feeling like I was underwater, that I eventually sold it, and I took the loss. And it's the only time I've ever sold something where I had to show up at closing. I think it was like $130,000. I literally showed up with $130,000 to get out from under this thing. And if I had waited a few more years, I would have been fine. But to free up the mental bandwidth that I spent feeling like I had this losing property. I'm having to cash flow it every single week. I'm trying to build a business. The business is costing a lot of money. The business in that season wasn't profitable. I was like, I got to shed this thing, and I'm going to just take the loss and move on.
Hard to put a price on mindset and your headspace.
That's right. And by the way, it was the right move. It was 100% the right move. It was a loss on paper, but I was able to use that extra bandwidth to create a lot more in intellectual property, a lot more in actual, other processes and systems. And I was able to focus completely on my business and create that. That business became profitable in a very short time frame from there. So it was huge, but it's crazy.
I'm pretty confident in saying, as it did for me, and I'm sure it did for you, going through that forever changed my DNA as an investor.
100%. Without a doubt.
I still will tell young entrepreneurs today, next to finding my business partner, the yin to my yang, the peanut butter to my jelly sandwich, going through 2008, and having a front row seat to market in a 100-year down cycle, was a great gift from God, because I received it, and it was hard and it was humbling, but I received it at an age where I was young enough where it didn't kill me. Right, I saw guys that were 10 years ahead of me lose businesses, homes, marriages, going through that turmoil because they were so far more out over their skis, spending every dollar they had, and then the machine stopped.
That's right. And you know what? I would say people always find it crazy. They're like, okay, so why did you get into real estate after that? I would have run the opposite direction. And it's so funny because that wasn't my thought at all. I mean, in retrospect, maybe I should have thought that way. It's like my first job. My first job was selling newspaper subscriptions door to door. I was so bad at it. I had no sales many weeks into the job. It was 100% commission. And people today are like, well, why didn't you quit? And I literally just said, like, the thought never crossed my mind. Like, I just never thought about quitting. I just figured I would figure it out at some point, and I did. And it's the same thing with real estate. The thought never crossed my mind that I wouldn't get back into real estate. Like you, I read Rich Dad, Poor Dad probably in 97, so maybe a year after you. And I was like, well, no, this is the way. And so when people are like, wait, you got into it? And I said, yeah, I just realized, okay, I'm not going to go into a rental that I'm not actually planning to rent. Like, I'm not going to buy a home that I live in that's actually a condo and then rent it when the numbers don't work. Like, if I'm going to get into it, I need to get into the real estate asset class that I like the best. I got to run the numbers ahead of time. I'm not going to do a transition like I did. So it's a totally different equation. And so when I went into that next deal, it was like, okay, well, here's all the mistakes I made. I'm not doing those again. This time's going to work out because I'm not going to make those mistakes. And I was actually more confident than ever.
Paid a little bit of tuition. What you just reminded me, Justin, because this happened when we met. So, I'll never forget being back in 2010. I'm like 29, maybe, whatever it was. I'm at a cocktail party with my parents, and somebody asked me, "Hey, what do you do?" And I said, "Well, I'm in real estate." And in 2010, they're like patting me on the head, like, "Oh, really? Oh, I'm sorry to hear that,
buddy."
and that hasn't happened until we were at until we were at that Wellspring event. And somebody asked me, "What do you do?" I said, "Oh, I'm in multifamily." They said, "Oh, really?" And I'm like, "Oh, could it be this good of a buying opportunity again?" I mean, it's been over 10 years since I heard that last.
That's right. Yeah. I mean, the world of cycles, if you can understand them, can make you very wealthy. And it's not that, most people think where you're living, it's going to stay that bad or it's going to get worse. But those of us that have been through it, or those of us that have read enough history or have enough mentors that have been through it where we can learn vicariously through them, we just know it's cycles. It's a season. If we can wait it out. I mean, that's why I like cash flow investing, because I'm not forced to sell anytime. If this thing is cash flowing, then I have a time horizon as long as I'm smart about my debt, right? And locking in long-term fixed versus short-term bridge loans and floating rates and all that. As long as I'm smart about it and it cash flows, then I don't have to sell, right? And so it's that where it's like you just want to, when you're in it, de-risk it in as best a way that you can. And then when others are most fearful, that's when you want to pay attention. And I do think, and I'm curious to get your opinion, for me personally, I'm pretty sure we're going to continue to see distressed assets, so basically prime real estate for sale at a discount because all these bridge loans are going to run term. All these floating rates have adjusted. People are really in a world of hurt. We've seen some of it happen already, but we're going to see more of it happen, I believe. I'm curious what you think.
No, I couldn't agree more. I know you're a well-read guy. And I know Howard Marks, I think, spoke what you were saying. We have these times where people are irrationally exuberant, but we also have these times where they're irrationally pessimistic, right?
Mm-hmm.
And because they extrapolate what's happening now, it's going to happen forever. There's definitely more pain to come. There are a lot of folks that entered this space and bought in white-hot markets and improperly financed their capital stack or improperly structured it. And to steal a quote from you, they didn't really think about de-risking the asset, right? Because multifamily is recession-proof and it always goes up, and it's a can't lose proposition when you and I know that it's the hardest hardest asset class to manage on the planet, and really takes a lot of execution and a lot of operations. we now have, I think we're approaching maybe 1,400 investors that have come alongside BAM and invest with us. Everything from a $50,000 check to, gosh, probably close to 20 million with some of my top investors. And we're hearing a lot of folks complaining or commiserating with my team about allocations to other sponsors, unfortunately, that are going to be locked up for a while, and hopefully they'll get their capital back. Some of those folks have already been told, hey, we gave the keys to the bank. Your equity is poof. And I think there's more to come, especially in what I would call boom bust markets, where the market got so high above the mean reversion is coming down the opposite direction in a meaningful way, and they just don't have enough time to hold on. And I think a lot of folks were hoping that we'd have rate cuts a lot faster than we're going to have. But fortunately for the US of A, maybe unfortunate for some folks that bought at the wrong time with the wrong sort of approach, we've still got some really strong inflationary forces in the economy. Wages are rising. We've got a tight labor market. We've got reshoring of a lot of jobs. Geopolitically, the world is breaking up. We're starting to think on how we green America. All those things are inflationary.
Yeah, 100%. And by the way, something else that I'll point out that just to take things a step further, you've got a bunch of people that have invested that not only is their money locked up, not only is this equity locked up, but there's now capital calls where they're being required to put more money in based on the agreement. And by the way, early on, people don't anticipate this is going to happen. It's still in the subscription docs, how it all works, even though it typically for the last decade hadn't happened. But now people are having to come in with more money. If they don't, their shares can be sold at a massive discount, right? So they can actually get bought out whether they want to or not. In some of these sub-docs, they can actually just get kicked out, right? They lose all their equity, just as if the bank took the keys. And then in some of these instances, they're putting in more money and then the keys are being handed back. So it's a tough situation. I think what would be interesting is to have you. So, you've lived in the world of multifamily for a long time. You know this space. I'd love to get granular with you and kind of break down what are all the reasons why these multifamily, and by the way, it's not just multifamily, but let's talk specifically multifamily because I think we're going to see it a ton here, maybe more here than anywhere else. Obviously, commercial like office is getting hit hard, but it's going to get hit differently than multifamily. And some of the deals, some of these multifamily deals are like monstrous deals in hot markets. So I'd love to hear from you, how is it that these syndicators, these sponsors are losing these deals? Like what is going wrong? So we could get into, bridge debt and term of loan. We can get into floating rates and what happens with the interest rates as they rise. You can get into covenants with the banks, right?
There's certainly a lot to unpack there with bridge loans. I think of a bridge loan or a fixed loan as a tool versus, a tool isn't good or bad. Justin, it's how it's used, right? So if I'm going to use floating rate debt, I better have rate caps in place and I better have cash on the sidelines in case my business plan doesn't go according to plan. There's also these other forces that are at work. So in many parts of the country, you saw interest rates 2x, 3x. So in addition to interest rates and how that affected loans, you've got these other forces at play, especially in the Sun Belt, Florida, California. You've got insurance premiums rising dramatically. I talked to a lot of CEOs in my space, and ones in some of these hotter markets or markets that are more susceptible to climate change are seeing premiums double, triple, and in some cases quadruple in the last 24 months. That absolutely kills NOI. In addition to that, you've seen municipalities chasing transactions and raising property taxes faster than anyone projected. And then in some of these markets, you're seeing occupancy start to drop. So you've got a lot of other forces at play. That occupancy being a supply issue in some of the hottest markets where you had lots of new construction. And so what the interest rates did is it really started to bring the tide out, right? We've heard people say it a thousand times: when the tide starts coming out, you see who's swimming naked. But
That's
then
right.
these other issues really exacerbated it to where even though rents are steadily rising, you're not keeping up with expenses. And so what you mentioned earlier with like loan covenants, if you get too far below your debt coverage, which you've got to have a certain amount of cash flow in excess of your mortgage payment every month.
And usually what, 1.25?
1.25 is the minimum. I think that's probably set too low. You know, we're feeling pretty lucky that we stayed conservative and kept our debt cover higher than that because it's come in handy now.
Right.
Bank loans are probably going to continue to be extended and pretend sort of format for most good borrowers who are still able to tread water. The banks have been told by the Fed, do not screw or try to drive down your best borrowers. Help them to get through these times. Debt funds, it's a tale of two cities. Some debt funds are in sort of that same mode as a bank. Hey, we don't want the property. We'll keep extending as long as we can. And other debt funds are really showing their true colors, their loan to own.
Yeah.
So there's a lot of volatility in the market. There's a lot of uncertainty, and I think you and I can both agree there's still some pain to come.
That's right.
What I can do or as any fund manager can do with internal operations is, instead of having, say, one asset that we bought together, we go out now, we buy a pool of assets, a portfolio of 12 to 1,500 apartments inside a fund. And maybe that's 5 or 6 locations across a couple, 3 different markets. So what that allows is the higher performing assets can sort of help maintain the lower performing assets, and overall the portfolio is still performing well. The other side of that, as I mentioned earlier, is keeping a lot of cash in the business. I think what sponsors started doing was they were distributing everything above a very minimum reserve amount of cash. No other business that you or I would operate would necessarily do that. Most operating companies, most businesses keep more cash on hand for unforeseen issues, right?
Yep.
And somewhere along the way, we weren't taught to treat multifamily like a business. It was more treated like an investment where you buy it, you hire a third-party management company who's going to manage it like an owner, and just watch the checks roll in. And now reality is smacking a lot of people right in the face.
That's right. Yeah,
Yeah,
100%. And, it's really tricky. I mean, we just bought a premier asset that was distressed here in Austin, collateralized with I would call even better property than what is already like Class A, just unbelievable multifamily. And we got it for pennies on the dollar. And it's going to be an incredible deal, a credible opportunity for us. And there's
what kind
so
of
much
discounts
more
are you seeing in Austin?
So this one, and I got to be careful that I don't mention too much of it because we're in the process of dotting the I's and crossing the T's.
Of course.
But this one, we came in late to the game as rescue capital. So this is going to be significantly discounted.
Yep.
Yeah.
So you guys will come in as rescue capital for the sponsor who sort of screwed it up.
Yes.
Yeah. And will you leave the sponsor in place, or will you bring in your own team to sort of take control and say, hey, we got it from here?
Yeah, we can't.
Yeah,
Um,
yeah.
So
And what do you think happens to the original common equity on that deal? You think they ever see any sort of pennies on the dollar, or they dead? They just don't know it yet.
I think they're dead and they don't know it yet.
Yeah,
It's a tricky situation. And this is a big name here in town. And I don't want to say the name because
no, of course not.
I don't want to drag anyone through the mud, and this is not public yet.
Yeah,
But our group has kind of come in at a very attractive price, pennies on the dollar, and we'll be able to take over the asset. And
are you doing those one at a time, or did you grow a rescue fund?
So this is just a handful of other people, with another group that we enjoy through the Lifestyle Investor Mastermind.
Yeah,
and
we've been raising our own preferred equity for a few years. We're about to raise that in a big way through an evergreen vehicle.
Yep,
it's a great tool. It's a great tool. I don't know if we'll do the rescue capital thing because we typically want to manage every line on the P&L, and we like the steady Eddie of the Midwest. But
we've got another deal that we did a pref equity on. So obviously you move into, the top position there, and you do get, full control at that point. So
yeah.
I mean, there's going to be a lot. I mean, it's good timing for that. There's a lot of opportunity in this space. And I think what's going to happen over the next 1 to 3 years, you're going to see these terms that are expiring on the bridge loans. You're going to see the further it goes on that these floating rates that didn't have rate caps are just not going to be able, they can't pencil anyway. They can't refinance into something else. And they eventually are going to exhaust all the reserves to the point that they can't do anything. I mean, they're dead in the water. And a lot of them know it. Some of the newer people don't know it yet. The last 10 years, every syndicator under the sun was making money, and it didn't matter how much experience you had as a sponsor. You could be, wet behind the ears, come out, have a killer deal. Now, you're an expert. Everyone should invest with you. And this is where I always talk about, like, we're actually building out a vetting deals course and due diligence right now that actually takes place next week. And here live in Austin, and then we're going to put it out as a production, a masterclass. But one of the things that we talk about, and I always talk about this, is I was very conservative over the last 10 years. So I missed out on a lot of what my friends considered great deals that they made good money on.
Sure, they just went to the bottom right of the projection and looked at the return, and they matched it up with other stated returns and picked the highest one, right?
That's right. And so it's interesting because, I missed out on those deals because my criteria was like, hey, I want long-term debt in place. I want, fixed rates, whatever the longest term we can get is. Can we get 20? Can we get 30? 30 years.
You do any HUD deals?
And I've done some HUD deals. Oh yeah.
Yeah.
Oh yeah. And to me, that's just, it's harder to lose there. And so now come full cycle, even though they made money on a lot of these deals and I missed out on those returns, they've got so many deals that are in jeopardy right now. And I've got none in jeopardy because I stuck to my investment criteria. I knew what I would invest in and why I would and what I wouldn't invest in.
If I could add 2 cents for your masterclass, I often get asked to look at somebody else's offering to poke holes in it. And I always, try to warn people, hey, I'm always a no when I'm looking at a deal, and I have to be convinced to be a yes. That's how I approach any real estate deal.
So good.
And I like to flip to the back, and I look at team and track record first. And what I noticed about a lot of these deals that are now going bust, I was looking at one in Phoenix, an LP sent me, he says, hey, should I throw more money at this? I went right back to the team and I looked at 6 co-sponsors, 3 pairs of 2. And they were all very well-educated outside of real estate, well-educated, well-meaning people. And their deal is vaporized.
Yep.
None of them had more than, I think, 2 years of experience in this sector.
It's dangerous. It's dangerous. So what do you
it's
think?
a heck of a buy. It's a heck of a sale right now, though, man. I mean, what a
It
time
is.
to buy. We've battened down the hatches on everything we own. We've told our investors hold periods are now normalizing because we were averaging, 3.5-year holds,
Yep.
right? Which makes the IRR huge.
It's the heyday.
And glad we put some W's on the board, but telling everybody now, like, guys, it's going to get back to 5 to 7 year holds in real estate. And if you are prepared to go 5, 7, and oh, by the way, if 7 years from now it's 2008 2.0, me and Justin aren't selling, we're buying.
Yep.
And that's the beauty of these assets if you structure the capital stack correctly.
Yeah. So what would you say if someone said, "Hey, Ivan, what are the 3 biggest keys to finding a great sponsor?" What would you say those 3 biggest keys are? And we're actually doing a whole session on this. So I think we're going to be doing 3 hours of a full day, like 9 to 5, masterclass, and we're going to build a course from it. So I'm curious to hear, like, what do you look at as the most important things?
The first approach I would really stress with somebody getting into this is the same way I would look at anything that I want to become more knowledgeable in, right? Education, peer-to-peer learning, that's been rocket fuel for my growth, is being in different peer groups and evolving into new ones. Tiger's my newest one, right? That's been another level up where I get to be a little fish again in a big pond, and that's uncomfortable, but it's where I'm going to learn more and gain more wisdom. And coaching, right? Having somebody that I'm paying to keep me accountable, to help teach me and show me the way. So biggest part there is education. And I think the next thing I would say would be repetition.
Mm.
It was like going back in time and doing those small deals, and even deals today. We look at 100 opportunities before we do one. So if I'm going to do a private credit deal, or I'm going to invest in a real estate deal, or I'm going to look at oil and gas or any sort of private alternative, I'm going to look at dozens of offering memorandums by various sponsors so that I can start to get what I would call like a fingertip feel of what a good deal looks like, right? And I'm going to start to notice when things are missing that it should be there. I'm going to start to sense those red flags just from the repetition of looking at so many. My partner, he's been in this game an incredible amount of time. He grew up in a real estate family. He's a way better deal shark than I am. I could put a decent deal together, and I love looking at real estate, but he's just got a better brain for it. And a lot of that is experience. He worked on $1.5 billion in brokerage transactions before we ever partnered.
Yeah, that's important. Goodness.
There's no shortcuts, right? It's Malcolm Gladwell. It's 10,000 hours.
That's right. Which is the equivalent of 10 years for those of you that are keeping track. 10 years.
If you're only working 40 hours a week.
Yeah, that's right. But still, I
with
think
a wife and kids now, I work less. But thanks by God, that's where I'm at already.
Someone can shortcut it in terms of years if they're really all in. But at the same point in time, if you're investing in a sponsor, you want to know they have at least 10 years.
Yeah. And when I was, raising money early and people were taking a little more risk, I had the management company going. So I had some sort of competency to offer. I'd been studying for real estate for a while, but I didn't try to go out and raise capital on social media or on platforms. I went to friends and family, and I used my network early on because I could get trust with those folks. They were betting on me more than betting on the deal. I can't stress enough, if you're trying to become a passive investor, you and I see this in Tiger all the time, right? You've made all this wealth in a concentrated way, and now you got to be an investor. That's not going to happen overnight. Don't be in too much of a hurry to deploy capital.
That's right.
Get educated.
Yeah, 100%. And be careful. I mean, there's so many influencers now that are raising money online. They're experts online. They're so smart at what they do based on their media personality and
what a great way to be a thought leader. I'm just going to talk about it all day. And
that's right.
The
way that they can build their profile, But most of these people make more money selling their products than they do actually doing the thing that they're talking about. I mean, it drives me crazy seeing how much money a lot of these people are raising that have no experience or very little experience in the space. But because their social media following is so big, people look at that and they incorrectly say, oh, they must be an expert because there's, 1 million people following them, 5 million people following them.
In a bad
so
way.
They know exactly what they're doing. No, they don't. They're just good at getting eyeballs.
How do you guys vet sponsors for your ecosystem?
Yeah, we've got a deep dive that everyone goes through. So we've got an internal team that analyzes them. We've got an external team that analyzes them, that this is what they do for a living. A lot of the private equity firms use them.
Oh, like one of the due diligence houses that,
a due diligence
do this full time for RIAs and PE.
That's right.
Yeah, nice.
And then we've got a family office that vets them. So we have 3 different teams that set up different calls, have different diligence processes, have different data collection processes. So in Lifestyle Investor this year, we will invest. We have spent over $300,000 just on our due diligence process for sponsors. We do a full background check on everyone that is a sponsor. So every GP has to go through that. And it's a deep dive. Our list of questions.
Well, that's your track record at stake now, right?
That's right. 100%. And luckily, we've had a great track record, knock on wood. No one's perfect and no one's going to bat 1,000, but I'm very pleased with our track record and with the performance overall. And
our greatest asset is our track record. That's sure.
Right. That's right. Well, this has been awesome, Ivan. Tell our audience where they can learn more about you and learn about the BAM companies.
Well, my name's here on the screen, so Google me, BARRATT. BAMcapital.com is easy enough to find.
I love it. That's awesome.
Yeah.
Well,
do your background check on me, please.
I love it. I
welcome it.
I think that's
just
so
don't
good.
Don't look at all my tenant reviews, because owning a property management company is quite tough.
You can't win there. That's impossible. I can vouch for that.
Especially in the early days when we were doing stuff that we had to do to raise revenue. We were taking on some deals that were not exactly fun.
I love it. Well, hey, this has been so much fun. I love ending every session with a question to our audience. So to those of you watching, to those of you listening, my question is this: what's one step you can take today to move towards financial freedom and to move towards living a life that you truly desire, one that's on your terms? So it's not a life by default like most people live, but a life by design. And what's one thing that you can grab from Ivan today that you can add to your tool belt that can help you get to that financial freedom stage faster? Thanks for tuning in, and we'll catch you next week.
Thanks, man.